All right, you ready?
I'm ready.
Let's do it. Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it.
Hey, what's up, amateurs? Welcome back to another episode. This episode is going to be a little bit different than our usual sort of back and forth with our guests. And I guess a little less seminar-like. This is going to be a much more hands-on sort of episode. Chris and I are going to do an episode that's been sort of discussed and requested upon for quite some time, right, Chris?
Yeah.
We've really been kicking the can down the road for a while. And a huge thanks to our friend Dimple for suggesting this episode. We're going to be actually valuing a business that Chris and I have never looked at. The only thing that we do have is we have all of the tabs that we want to look at just pulled up on the screen. So we're going to do a fully candid sort of walkthrough of what Chris and I do to understand and value a business. And a quick disclaimer before we jump into this, like, this is not what it looks like for like a team of Wall Street analysts to go through a stock. That takes weeks, probably months of coverage following company earnings calls. So we're going to do a really expedited kind of like fast and loose analysis here. So take this with a grain of salt, but we're going to walk through pretty much everything that I look at and Chris looks at to get a real valuation for this business. We're going to be looking at the revenue, looking at the 10K, some historical performance, and we're going to spit out, an intrinsic value for this stock.
Yeah.
Chris, anything to add before we get going?
No, really excited for this episode. Like I said, Ben and I are not Wall Street analysts or, even just a firm in general. So we don't have some crazy formula like them or a bunch of analysts to work on the same company. But this is just kind of the way that we do it. And we hope you guys enjoy it and get something out of this episode.
Yeah. So for this episode, if you're listening to it on Spotify or, any of our other sort of audio-based streaming, definitely recommend jumping over to YouTube to sort of follow along. I'm going to be doing a screen share pretty much of everything that we're looking at. So let's get right into it. And I'm going to start with the 10K.
You want to tell them what businesses it is?
Yes. So the business that you can see it right here in bold, if you're on Spotify, the business that we're going to be valuing is Ulta Beauty. And this is definitely not a sector that I'm super comfortable with in terms of just like knowing revenue streams, knowing the business, and retail especially is a sector that I have just been kind of putting an 8-foot pole away from me since the pandemic has begun. But that being said, there might be an undervalued opportunity here that, maybe Chris and I will be buying Ulta Beauty by the end of this. We literally don't know yet. So yeah, let's jump into
full disclosure. Both of us do not own this stock unless it's in some crazy broad index fund.
Probably is.
And I'm sure our girlfriends would know much better about this product than us in general.
Yeah, they're probably going to be cringing after they listen to us doing this. It's going to be brutal. So bear with us. We're going to walk through this. At the end of the day, whether it's a retail business, like Ulta Beauty selling, eyeliner, beauty products, face masks, or Tesla selling cars, all businesses are just cash generating machines. They just sell things, whether it's goods or services. And that's really, we're just boiling it down to its simplicity. We're looking at dollars. So the first thing that I really like to look at, especially when I'm looking at a business that I'm not really that familiar with, and Ulta Beauty is one of them, is I just jump right to the revenue breakdown in the 10K. And the 10K, just for our audience, if you guys haven't had a chance to watch our financial ratios or financial statements episodes, is the 10K is our annual report. That's the company's, full aggregated roll up of all financial data for the past year or whatever their fiscal year is. Typically it's a calendar year, but it might be reported in like March or February of the following year. So looking at this, I'm going to zoom in just in case you guys can't see this. I have my giant monitor here. I wish I had 3. So if anyone wants to donate me another monitor, you're in. Okay. So we're looking at this. We've got 5 categories: cosmetics, skincare, bath and fragrance, Third, healthcare or hair care products and styling tools. 4, services. 5, other. Companies love that other. It's usually a small composition, but that could be their miscellaneous products. I mean, that could be interest potentially. So what I'm going to do here is I'm going to take these categories. This is not going to, we'll just do cosmetics, skin, hair, services. And what I'm going to be doing is I'm going to be populating this little spreadsheet that I have over here. This, if anyone's interested in using this tool, this is a notebook that I kind of developed for my own investments. Chris, can you still see the screen here?
Yep, I can see it.
Awesome. So what I'm going to be doing throughout this episode is just basically populating this notebook. I think about it as like an investment journal. And, you know, folks listening to the show, you might have your own strategy that works for you, but I really like this sort of like dashboard kind of layout of things. So we've got, what do we have here? We have cosmetics, skin, hair, services, cosmetics, skin, hair, services, other. And then I'm just going to do a hard input here. 50, 22, 19, 5, 50, 22. Is this going to work, Chris? 19.
I don't know.
I bet it's not. That's fine.
Well, then you could just put in the revenue side,
That's
just
exactly
break
what I'm
it,
gonna do.
just do a basis of.
On revenue. So the way that I have this, and I know if you're listening to this on Spotify, it's going to be a nightmare. But essentially what I'm doing is I'm copying and pasting the revenue for the past 10 years into the into my little spreadsheet, and it rolls up into the formula here. So okay, I'm going to do, Chris,
I can help you with some numbers.
If you could you get me just like the fractions?
Yeah.
I'm getting there. What is skincare?
Skincare. What was that? That was 20.
22.
1,600.
I just need the percentage. I can pull it up. Sorry, I didn't
sorry.
prep you to do this. I thought this was gonna be a lot easier. Times 0.2. I actually have it, Chris. No worries.
Okay.
So as you can see, this is obviously not an overly technical thing. I'm really just making a pie chart. But what's really nice about doing something like a pie chart or a bar chart is you get to get some optics on how does this company make money, right? Like it's one thing to think that you found the stock that's the next big thing. But if you don't know how your company makes money, you're kind of just guessing. And it also helps you filter through news. When you hear that, let's say Ulta Beauty. So we're going to look, I'm almost done here. So we have the full.
Give you a heads up. I think the skin's supposed to be 22%. Is that right?
I have that as 22. I just so essentially, why is it doing that? I multiplied it by 0.22. Oh, I know what I did. Whoops. Equals. Thank you, Chris. Math is hard. Okay, so
there we go.
Excellent. That looks good. So essentially, like what I'm doing, and I was blabbering a little bit because I'm doing spreadsheet. This is like the first time I'm talking through like a spreadsheet on a show. This is interesting. What's really nice about looking at this, okay, we're looking at this business portfolio mix, and this is something that I made, and it's helped me understand businesses. So clearly, Ulta Beauty is, you know, pretty all in on cosmetics. I mean, that makes sense, right? Like they're a cosmetics company. But let's say we heard that Ulta Beauty is in their services revenue, and this is in, I'm almost certain that this is in millions.
Yeah.
This is in millions. So we have $370 million in service revenue for 2020. Let's say that we heard, you know, in the news that they're going to be growing their services by $5 million. Stock pops 30%. You can go ahead and look in this little portfolio mix. $5 million is meaningless. That's less than 1%. That's less than like 1% of 1%. So when you have sort of like a scale for the company's revenue mix and of like where they drive their money, you can sift through news and understand, is the stock trading, you know, at an elevated sense on the news? You can really start to make sense and assign value to the news of your company. So that's the first thing to do. I take a revenue mix breakdown. So Chris, do you want to take over for the next point?
Yeah. So, like just talking about the breakdown and the standpoint of that in the financials.
Yeah. Do you want to go to Morningstar? I'll jump over to it.
Yeah, if you want to jump over to Morningstar, and I also like Yahoo Finance is kind of a quicker snapshot as well. So normally I jump over to Yahoo Finance and I'll do, the ticker Ulta to look at it. So basically what we're looking at, so I'll just use Ben's right now. He's looking at Morningstar right now. You can look at, obviously, their dividends. They don't pay a dividend on this stock, so it's more of, I guess, consider it growth. Some people consider it growth versus dividend stock. So it's more of a growth company because they don't pay out dividends. They're always reinvesting in the business to try and grow and get a larger market cap instead of
Yep.
giving some money back to their shareholders. Also, even if you're just looking at the top line, so the very top line is revenue. Back in 2011, their total revenue was 1.4 billion. As of right now, in 2020, it's 7.3 billion. So that's what, a 6x return, basically, a 5 to 6x growth in top line revenue, which is fantastic, especially when you're talking about billions of dollars. It's one thing to do it when you're going from 1 million to 5 million or 6 million. It's another thing to do it in multiple billions. So obviously they're a business that's constantly grown. You can even see they like huge jumps in, like, it's very flat or slower growth up until 2016. And then really 2017, they just kind of took off and they grew their top line by a lot. You can look at the gross margin percentage. So that's basically just saying the gross margin relative to, is that expenses, I'm guessing,
Expenses,
right?
yeah.
Yeah,
So these are
expenses.
revenue.
So 33% gross margin, meaning that, 70 or 60 some odd percent is used for expenses on the business. 33% is actually money that they get to take when it gets to the bottom line, and they get to use to whatever they want. If they want to pay dividends, they want to reinvest in their business. This is just kind of like the high level looking at it, basically. Ben, do you want to take it over from there?
Yeah, I think what I'm going to do really quick is I'm just going to move this spreadsheet over. And what I wanted to do really quickly was just to plug in a few metrics, just so we can get a good sort of like holistic picture from a graphical standpoint. So I'm just going to, let me just move your face out of the way. No offense, Chris.
No problem.
I can still see you. You're still looking good.
Thank
So
you.
I'm going to take we have not the operating income. I'm going to take the gross margin. I'm just going to take a few data points here. Obviously, we're not going to go through every line by line. This is just something that I like to look at. So we talked about the gross margin. I'm going to get some of the net income over here. This is basically profit. So we're going to take a look at that. We obviously don't have dividends, so we're going to skip that. Capital spending is definitely something I want to look at as an investor to see how does the company's spending and investments from an asset standpoint translate to the top line, and that being the revenue. And we're looking at, the capital spending, it's obviously negative, and this is just a formulaic thing that I have in my chart, so ignore sort of like the trend. It's basically going up. So like the negative means that they're spending it, but taking a look at it, it's pretty flat. It's pretty flat, and they're annualizing almost a 20% revenue growth rate year over year for the past 10 years. I mean, that's pretty impressive to me, Chris, to see that they can spend consistently, but also grow in the high double digits. I mean, that's impressive, actually.
Yeah, even looking at the chart. So exactly what Ben's saying. It's the reason it's going negative because it's showing a negative number, but it's basically they're spending to reinvest into their business. So it's not necessarily a bad thing. They're spending to grow their business. Even if you look, there's kind of like an anomaly. In 2018, that's I'm assuming it's in millions of dollars. They spent $441 million and their top line revenue was 5.8 billion. But then the following year, they spent 319 million and they still grew their top line revenue to 6.7 billion. And then even the following year, they spent 299 million. So it went down, that their spending was less and less each year. And then once again, they grew their top line to 7.3 billion. So that's even awesome that they're drawing back on their capital spending, but they're still getting the benefit of either excellent products, a great marketing team, just selling products or finding ways to maybe they expanded their e-commerce side of the business. So that
Yeah.
way, once you set up your website, yeah, you got to host the servers and pay for the domain. But once it's really set up and running smoothly, it's probably translated. That was maybe in 2018, you'd have to go and break down in the 10K and see really what that was in 2018. So now we're right now in 2020, but you have to look at the 2018 10K to kind of do some like detective work to figure out what was spent there, why it was so high, and then why we're seeing awesome returns on that.
Yeah, that's a really great analysis, Chris. And I think for this episode, and just a disclaimer, if you're looking at this on YouTube, ignore the cash flow projection. I haven't punched in all the numbers that I want to take a look at just yet. And we're going to do a little highlight of our TAI tool, the valuation calculator. I'm going to show you what I have, which is essentially, it's the exact same thing as our TAI tool. I just have it in one centralized place. So I'll show you on both. But now that we have some of the numbers built in here, just to see it graphically, I mean, this company is so consistent, and I have just a little like a line of best fit here, and the R squared, which is essentially the correlation factor. A 1 being it's entirely correlated, like it's a perfect fit. It's a perfect line of fit, which is impossible because these are not straight lines. These are sort of like semi-exponential. I don't know what you'd call them. I guess they're just curved.
Yeah.
They're not exponential, but the fit is just really, really tight. Like honestly, anything above a 0.75, 0.8 is a really tight fit for a company. So what that tells me is that over the course of a decade, they're just like plotting, dots on a line. And Warren Buffett loves companies that are not only consistent, but predictable. And a company that can grow at 20% and be predictable, I might buy this company after this. We'll see what it's valued at, and I want to get to that. But I mean, these are impressive things to see that you can correlate the. Well, I haven't done a correlation, so that's sort of I misspoke there. But to see the capital spending be relatively flat, but we're still growing at 20% growth rates. We're growing profit by almost 30% year over year, and then we're looking at free cash. That's the number that I love. Wow,
Yeah.
29% year over year. That's awesome. Chris, that's awesome. You think it's a tech company.
And I know Warren Buffett kind of prefers more of the straight line. It's he always refers to it as the steady compounders or the constant compounders.
Yeah.
He prefers that. I mean, we can talk about philosophies and everything, but Warren Buffett's more of an old school philosophy, and that's not a bad thing. I mean, he's one of the most successful investors of all time because of that. But he kind of avoids businesses that go more parabolic because he fears that when the hype of someone being like, oh, this company grew 100% or 50% or 75%, it's kind of hard to sustain that. He would much rather take a business that compounds at 10% annually over a business that grew 50% leaps and bounds in 1 year, because your new target is you're trying to beat your last year's best. And it's very hard to do that when it's astronomical numbers of 50%. I mean, 10% can kind of even be seen as astronomical at times. But if you're able to do that consistently over a decade, not saying that any business is going to succeed like that in the long run, but Warren Buffett's like, there's a much higher percentage of it succeeding in the long run if it does that. A lot of times, Warren Buffett likes to avoid the news and hype and the Wall Street Hornets, as he calls them, of people that are just like, oh, we're hopping into this business because this is growing at 50% a year, 70% a year, 15% a year. There's the infamous bet that Warren Buffett took with, I'm drawing a blank on his name, one of the hedge fund managers in 2008, saying you could pick any hedge fund you want to, any hedge fund manager. You could do a collection of hedge funds. I'm going to pick the S&P 500. I forget who that was. I forget who it was too. I think it was,
we'll look it up.
We'll look it up for the show notes. But basically, he took a bet with one of the hedge fund owners. He's like, you can pick your own hedge fund. You can pick, Ray Dalio's hedge fund. You can pick whatever you want from 2008 to 2018. It's a 10-year bet. Whoever wins, $1 million had to be donated to the person's choice. And from 2008 to 2011, Warren Buffett was getting crushed, or at least Warren Buffett picked the S&P 500, and this hedge fund manager picked a bunch of hedge funds that were up like 30 or 40%. But then all of a sudden there was a huge, gigantic market correction, and that hedge fund went down to like negative 75%, where the market, the S&P 500, went down to like negative 10% or 15%. And then basically the loss was so great, the hedge fund was never going to be able to catch up unless they had really, really risky bets. So then 2018 rolls around, and Warren Buffett had crushed his buddy. And he's like, yeah, it was a very good, it was a good challenge. I just picked the market over 10 years. and ultimately was given the $1 million to donate to a charity of his choice. But just goes to show, like, Warren Buffett would take the consistent 10%, or, you know, take even, like, you don't get as much of the upside, but you don't get as much as the downside, in order to try and, you know, don't bet against the market, basically, is what Warren's saying.
Yeah, and that's a strategy that I definitely subscribe to. And the last couple of things I want to do before we sort of zoom out is, you know, this is something that really ties into Chris and our last episode or a few episodes ago, the financial ratios. These are a quick things that I like to look at. And Chris, that was a good point before, just reflecting on what you just said. You got to protect your downside. That's the most important thing. Like, you can't compound your money in terms of a positive sense if it's always going down. If you always have to scramble to try and beat the market, and, you know, you're dealing with 75, 80%, you know, losses of your principal, but, you know, you have those 150%, 200% a year, it doesn't matter. And it's like, it's also a matter of your mental health. Is it worth it? You want to reliably grow your money, protect your wealth, and build that. And it's always about what is the next best alternative. And if you can get, you know, a secure rate of return with, you know, not a return on equity, with a bond, or, you know, otherwise, you should probably look there.
Mm-hmm.
Yep. So let me just look at return on equity. This is something that I definitely like to look at. I'm just going to basically just fill out. This is sort of a financial statement summary that I kind of created for the items that I look at. And it's not that these are the most important things. They're both the most impactful financial ratios from my perspective, because one, I understand them the most. And I just think it tells a holistic story enough for me to decide if it's worthwhile for me to go down the rabbit hole of learning more about this business. So I'm basically copying and pasting. Chris, if you want to talk through anything that kind of pops out at you with these ratios as I walk through them, I'm basically just applying some, these are in percentage basis.
Yeah. No, that's fine. I was just wanted to make the point that obviously Ben's just copying right now from Morningstar is kind of where our go-to is.
Yes.
So he's just copying the Morningstar, the growth over the last 10 years, or the numbers for the last 10 years. So he's just copying a line from that sheet.
Yeah. And honestly, it's pretty hard to get 10 years plus of financial data in an aggregated sense. Like, Chris and I have been lucky to be able to find some of these things every so often. What you can do, I mean, the SEC make all of this information is publicly available. They're called publicly traded companies for a reason. And that means that their information is publicly available. I don't know why their debt to equity is blank for these years. Let me just show you really quick. So if you can't find like a Morningstar or a Yahoo Finance roll up for 10 years, don't be discouraged. Like, take what you can get. And you can also look up, you know, let's say I want to look up Ulta Beauty. Let's say I couldn't find 2015. Just look up Ulta Beauty at 2015 SEC filing, and you'll be able to pull it up. You just won't be able to pull it up from a singular sheet, but that information's all there. And it's worth taking a look at it.
One little note as well. I know Yahoo Finance normally only gives 3 years of data.
5. I think it's 5 sometimes.
Oh, they give 5? Okay.
Yeah, I thought so.
Yeah, I think you're right. But so a lot of times you can pay them to give it in a more clean, concise manner. I know Morningstar is the same way. I know, you know, either whether you pay for it yourself, like Morningstar is like one of the good ones, as well as Yahoo Finance. But like exactly like Ben said, if you want to do more of the grunt work, you can always look up their 10Ks from any year or the SEC public filing. It's a little bit more time consuming. So, you know, you're kind of paying for the convenience of the data.
Yeah, I'm taking a look to see how much it costs. They're not showing me really quick, but here's a little tip. We're obviously not sponsored by Morningstar, so we wouldn't suggest this, but I mean, if you have a list of companies that you really want to take a look at and you're ready to make a big position somewhere, and you know, you looked at 5 years data, you don't really want to look too much more for the rest of your portfolio, just start a 14-day free trial and just dig in. Maybe take a couple days off of work and do your analysis for 14 days and then cancel your subscription. I feel like that's a totally fine thing to do. Okay, so really quick, looking at some of these numbers, this company is really well managed.
Yeah.
The debt to equity, I'm not going to do a full 10K read through. We're not paid to do sort of an audible read through, and you do not want to listen to us read a 10K. That is so boring. But I need to understand a little bit more, and maybe I'll put this in the show notes when I read in more detail on my own. This might be because they don't have any liabilities, which I find surprising.
That doesn't
But
sound right, but
doesn't sound right, Chris. If you want to find something in the background, it's not worth
yeah.
it right now. But if you can find a reason, I don't think it'll be easy to just conjure up. But current ratio, that's basically just the assets coming in versus the liabilities out, right? That's the immediate assets versus immediate liabilities.
Mm-hmm.
They're looking at, I mean, they have way more cash coming in than cash going out. So that's a company that can really manage their cash flow well and also manage their liabilities. Well, more to come on why their debt is blanked out here. Morningstar, we're looking at a numerical analysis. So obviously things are not holistic and qualitative in that. So the return on equity, I mean, this is awesome. 27%. Like, I feel like what I look for is low to mid double digits for a good company on the return on equity. And basically that means that management is just deploying capital and making tremendous returns. These are like Warren Buffett returns.
Yeah.
This
Like
is
20%,
impressive.
21%. It's, yeah.
That's awesome. That's really impressive. If you can find a company that can deploy capital consistently over a 10-year period, because these numbers, when you're looking at like a recently public company, obviously, I mean, you can't see, but let's just say these numbers were blank from 2011 to 2017. You'd have 3 years, maybe you'll see a 300% growth on investing in capital. That number just ends up reverting to the mean over time because it's just impossible to deploy capital and get those types of return year over year, especially as you scale. It's just hard to make that kind of return to make your money grow that fast. It's easy to make small amounts of money grow, but not at scale. It's just very, very difficult because the markets are not as liquid. So very good company. I'm impressed at this. I'm not, the only thing that's concerning me, and that's just because I don't understand, is the debt to equity piece.
Yeah,
But
I'm on Yahoo Finance right now. In 2018, 2019, it says total debt 0. So, or it's blank. So it's something I need to look into. I don't know why.
Okay. Well, at least we verified that. I mean, maybe they just paid it off. I don't know.
Yeah,
I don't
maybe.
know. But I'm not going to speculate on that. But just looking at this, really no red flags other than the debt to equity. These are the metrics I really like to look at. How is the management returning on capital? Growth rates. I mean, that's why we're investing in businesses. We want to know how they're growing. And this free cash flow number, that we're going to look at that sort of as the last piece of our valuation. But Chris, I wanted to jump into, starting to talk about externalities. And the first thing I wanted to discuss is if you had a chance to take a look at any competitors in terms of sizing. I'd just like to understand like where Ulta Beauty stacks up against its competitors. And then we can take a look at some internal risk factors.
Yeah, so definitely I want to say, so Ulta Beauty's market cap, I know that's kind of one of the first things I normally look at is the market cap of the business. They're at 17.9 billion, which is nothing to scoff at. That's a huge business. That's gigantic. But when it comes to comparisons to the space, as of right now, like the top dog, I would say, or at least when I looked up, was L'Oreal at $207 billion. So I know L'Oreal, you traditionally
207?
207 billion, yes.
Wow. Okay.
So you normally when people think L'Oreal, you think their shampoo, conditioner, stuff like that. I'm sure that they're very big into the beauty space as well overall. I'm not, aside from their shampoo and conditioner, I don't really know anything else. There's also Estee Lauder is at 101 billion, so 101 billion. There is, I'm going to mispronounce this, Kao Corporation or KAO Corporation. They're at 32 billion. And then this is a German company, Beiersdorf AG at 23 billion. It BEIERSDORF. Yep.
Did I spell that right? I just kind of spitballed it.
Yeah, no, that's completely right. 23 billion. So as you can see, they have there's smaller competitors as well, but these are kind of the top dogs in the space. So even if you're just looking at it at L'Oreal by comparison, they're probably fifth largest company. Or not L'Oreal. If you look at Ulta Beauty, they're probably fifth largest of these top competitors. And there's definitely much smaller brands. And I know probably a lot of them try and acquire some of the smaller brands or do brand deals with celebrities, such as they'd love to do deals with Kim Kardashian or, the Kylie Jenners and stuff. I know those are more celebrity brands. They have their own brands, but they love to partnership and do stuff like that.
Yeah. And I don't want to just like do a Googling exercise here just because I feel like that's kind of distracting. But something that I do like to look at, I mean, Chris, if you think it's worthwhile, we can do it. I don't think that for this exercise, it's valuable, but something I do like to look at, I'm just scrolling over to my little stock valuation thing, is I will take all of the competitors and plot in all the revenue, net income, and do a size comparison in terms of like percentage of scale. How much bigger are they? And then I'll also see how their profit margins compare, because that's something that I think translates much better than just like generic size of revenue. Because I mean, let's say L'Oreal, they're like 10 times the size of Ulta, but they might have 15 times the number of employees. So maybe they're not being as, you
Yeah.
know,
And
lean or as efficient with their capital. That's just something to look at as I look at revenue to net income, and then I get a margin and then size comparison. Who's being really efficient with capital? That's just something I like to look at.
And Ben, you make a great point, because let's just say L'Oreal, they're taking in their market cap is 207 billion, which is awesome. That's a lot. But if they're taking in, 207 billion, but they're spending 300 billion, you're basically kicking the debt down the road. So at some point you want to become profitable. So,
Yeah.
you basically, what Ben's saying is he's comparing them to see which businesses are the best capital allocators. At first we were kind of concerned with Ulta Beauty holding no debt, but that might be they paid off all their debt and they're growing organically at this point. Or, they don't have any outstanding debt where L'Oreal can have billions upon billions of outstanding debt. Yeah, L'Oreal's 10 size by comparison, but Ulta Beauty can basically eat L'Oreal's lunch by being better capital allocators and really working with their capital and growing organically and naturally and slower, quote unquote, but they're not taking on as much risk in doing so.
Absolutely. They're protecting and building shareholder value. I mean, that's
Yep.
really, I guess, in the traditional sense of like what CEOs are meant to do. It's meant to bring value to the shareholders. That paradigm is kind of shifting. It's more about just like building a good business that's both good for the environment and for the company. That's what they say. But that's, I mean, that organic growth piece, Chris, that you said, that's huge. Understanding that is like, do they have a real niche? Like, does this business warrant existing? Like, if they have to just take on 7, 8, 9, 10x leverage, just basically just a bunch of debt to exist as a company, maybe go into a different line of business. Like, honestly, at that point, it's like, if you have to force something, you probably don't have the right idea. And maybe I'm not appreciating things, situations change, but like,
Yeah.
that's my take. If you can't deploy capital reliably and safely, you shouldn't be in that business.
Yeah. So now that we've kind of talked about, overall comparison of businesses, I know I kind of want to stay zoomed out at externalities and kind of look at risk factors. So I know Ulta Beauty and most companies, when they have 10Ks, they list their risk factors.
Yep.
So obviously in listing risk factors, it's like, negative impacts of COVID. That's one of the first ones they talk about. I think the majority of businesses talked about that. It's kind of not saying it's a wash, but, all businesses struggled with the same thing, the lack of retail stores, the lack of people being able to go and travel, the lack of, just travel and tourists in general. So,
And lack of spending. I mean, savings rates were just so up.
Saving rates were up, meaning that people are storing cash because of the fear of, the unknown. We don't know if the pandemic was going to get worse. We didn't know if it was going to get better. We don't know if the vaccines were going to work. There was a lot of unknowns. The job market was, increasingly getting worse. We're hoping that we're turning the corner now. But I just kind of wrote some high level things of what they wrote down aside from the COVID thing, because I knew everyone was going to say that the same thing for COVID. So they were talking about not being able to sustain their growth plans, which and they just kind of put a line in there like, what if we're not able to sustain our growth plans? Distribution, not being able to keep up with demand, for the online, when online orders come in, not being able to fill those because of factory workers not being able to be in a closed, confined space because of the COVID, interruptions to operations, such as whenever they source things in third world countries, if, with COVID getting worse, potentially not being able to bring in raw materials to make the cosmetics that they're trying to make. A cybersecurity breach, which I thought was an interesting note, because I think a lot of companies kind of gloss over this. Sorry, Ben, I'm just kind of, I know you're scrolling through. I'm just kind of like hitting the high line points.
Yeah, I think I'm trying to find it. I think I got it.
Yeah, so basically, cybersecurity breaches in the sense of a lot of, we saw in 2016, there was a lot of security breaches with Facebook or big companies like that. If it can happen to a company like Facebook, which is a lot bigger in market capitalization than Ulta, it's a risk for Ulta because, if God forbid a hacker came in and stole their database or hacked their servers and now has a bunch of personal information of, Ben and I and, or, our girlfriends or people that order from Ulta Beauty, that's kind of a risk to the customer, and people are not happy when their data is being exposed to bad actors, basically. E-commerce unsuccessful. So if they're not able to drive business people to their e-commerce business and able to generate revenue off people going to the website, whether the website's clunky or not really user friendly, or their carts don't work for when you go to check out. Third-party vendor interruptions. So obviously, like I said, not only using countries, but if they have a third-party vendor that they're getting raw materials for some of their cosmetics, that can be an issue. So these are just kind of like a lot of the issues that the businesses list out and how they're a risk to their business. Normally they don't have the solutions if they were to happen, because obviously they haven't happened or they aren't happening at the moment when they're risking these things. But it's good to know that the business is thinking about these things. These are the potential risk factors of things that can happen. They explain how this would be detrimental to their business. And when it happens, you hope that they have a plan to counteract a lot of the risk items that they've addressed in their 10Ks, at least their most recent 10K. It might be very different than the 10K of 2010, because there was a lot different factors. The internet was still growing and developing. Social media was kind of, at the precipice of really taking off. Amazon was at the, basis of taking off as a gigantic logistics company. But you hope that their 2020 risk assessments, their team, their senior leadership team and the board would have an idea of how to counteract them, because they obviously listed them as risks that they saw for their business. These were two other things that I noted from the earnings call. So the CEO, her name is, I think it's Mary Dillon is her name. I correct me if I'm wrong there. Sorry about that.
No, you're fine. I mean, this is literally the first time I'm looking at this company. I don't know.
Yeah, Mary Dillon. She took over in June of 2013. Obviously, the 10 years that we're looking at is from 2011 to 2021. So her 8-year tenure basically was what Ben and I were looking at of the back half. And there's a lot of explosive growth. It's really awesome. She's been there for 8 years. And, in all honesty, the business has done very well by the numbers. So that's something that kind of worries me, that she's stepping down. I don't know the reasons, and a lot of times they don't mention. I don't, hopefully it wasn't bad blood between her and the board. Hopefully it's just she's stepping down for her own accord. And then also on top of that, quarterly sales were down for this quarter. So it's kind of bad. She's stepping down in June, so it's not immediate, but it just goes to show that she's stepping down. They haven't picked her successor yet, but they're probably in the process of picking her successor, and quarterly sales are down. So
this quarter, Q1?
For this quarter, yes.
Okay, what I'll say to that is I would need to see. So this is another thing, and obviously this is the first time Chris and I are looking at this. But when I'm looking at businesses like a retailer, or really just sort of any industrial sort of like materials company, I look at the cyclicality of the business and trying to make sense of really just like the psychology of the business and understand like what is driving revenue. So like what would be the strongest quarter from my perspective? I would say Q4 of every year.
Christmas
You've
time,
holidays, ancillary birthdays, you've got New Year's, people are celebrating. Even in New Year's, people are prepping for like holiday, festivities. People want to dress up nice, get their beauty products. Skin is dry in the winter time. You probably want to get your face mask and your hand lotions. I would imagine Q1 would be a lot weaker comparably to Q4. That would be my expectation. And we're in heightened savings rate environments where people are just like, where do I put my money? Stocks are skyrocketing. Buy Bitcoin. You should do that. Yeah. So that's just something to take a look at. Is just like the seasonality of the business. Don't necessarily jump to quarter by quarter, because I think it doesn't tell the full picture. What I would recommend is do a Q1 to previous year's Q1 to get a more accurate picture. So that's my 2 cents. Chris, that was an awesome walkthrough. And for the risks specifically, this Ulta specifically, and I'm going to switch screens in a second, but the risk breakdown, and that's common for every single 10K. The risk breakdown is page 13 to page 24 of the 10K, which is, the numbers don't matter, but 11 pages of the company is telling you what could possibly go wrong with the company, so you don't have to. And maybe they missed something, but at the very least, like what I look at for the risk factors in a 10K is, if any of these things materialize, and I try to look for the top 3 to 4 items, if any of those things materialize or a succession of them materialize, my investment thesis probably has changed, because it probably has changed for the business as well. So what I always recommend folks and for myself is when I invest in a business, I get my valuation, I look at the stability, all the growth trends, I look at, the long-term prospects for the business, but I also have like a hit list for the company that, if the X, Y, and Z things happen, 1 to 5 items, if 2 or 3 of them happen, I'm going to consider selling, because the thesis has fundamentally changed and there are risks that have not been realized by the business. And unless I can make sense of them and really, really justify it in myself, which, like, I'm not a genius, I'm not going to, pretend that I am. We're the amateur investors. Chris is smarter than me. If those things materialize,
Give me too much credit there.
if those things materialize, I'm probably out, because if there's a business that that can hedge their risks out and they're not exposed to these externalities that the company is stressed out about, I should probably look elsewhere. So that's my advice. Have the reasons why you want to buy the business, but also understand the reasons why you would sell. Get that up front. You need to understand why you would sell and what would drive you to sell, and not just hope it works out. Okay, this is the fun part. Are you ready, Chris?
I'm ready. I can't wait.
Is there anything else you want to talk about before we start jumping into valuation stuff?
Nope. I think we're good.
Groovy. So this is the last piece, loosely, of our valuation process. And if you want to use this, you absolutely can. It's on our website. You go to TAI Tools or TAI Tools, and you literally just go in, click our valuation calculator, make a copy of this, and you have your own spreadsheet, and you can use it forever. It's free.
Yep.
I use it. I like it a lot, actually.
Me too.
It works pretty well. So we're going to walk through exactly how to use this. This is not only just a valuation update, but this is sort of our, this is our pitch for our tool. So if you like it, use it. So the stock ticker, we are going to put in Ulta, ULTA, and that is actually going to drive the valuation. I have some calculations in the background that are taking all of the stock price information. We're looking at number of shares outstanding. That's all real time. So definitely plug in the share ticker. You need that for an accurate valuation. Mm-hmm. The discount rate, that's really, I'm going to pull my other spreadsheet into my other screen, and I'm just going to talk through what I'm doing in the background. So the discount rate is really what we're going to be doing is we're going to be projecting out all of the cash flows for this company, and basically predicting how much money is going to be put into my pocket over time. And this discount rate is essentially the common denominator for taking the future money, which is, time is money, and money has different value over time. So we take that money and discount it back in today's terms so we can understand what is the net present value and NPV, or, the current value. What should I be buying the share for? Discounting it back in today's terms. And that's basically just how we get a real value for this business. And what I'm going to be using is the WACC to get that. It's called weighted average cost of capital. It's basically just like, how much does it cost for them to deploy capital? I don't have a really good definition for that. Chris, if you want to look that up in the background, yeah. This is just what I've historically done. And this is what every discount cash flow model tutorial has told me to do. I usually will use just the WACC, and I'll usually just pick the mid. There's a full calculator for that. You basically are comparing the cost of equity, you're taking in the tax rate, the cost of debt, and you come out with this figure here. And for Ulta Beauty, it's 9%. So we're going to be discounting back to 9%. And Chris, if you find it, just interrupt me at any time. So this discount rate is...
I had the definition. Represents its blended cost of capital across all sources, including common shares, preferred shares, and debt. The cost of each of the capital is weighted by its percentage of total capital, and they're added together. This guide will provide a breakdown. So basically, it's just looking at the cost of equity versus the cost of debt and adding them together to get the weighted average cost of capital.
And I need to understand that, because they're using the word in the definition. And that's why I've always struggled with weighted average cost of capital, is they always use the cost of capital in the definition.
Yeah.
I want to understand, what are they costing? What is the cost? that's fine. We're not going to worry about that right now. Anyone listening to this, if you want to shoot us a message or, post on our social media about what you understand about weighted average cost of capital, go ahead and do that. We really appreciate that. The risk-free rate, this is a huge, huge thing to take a look at. The risk-free rate is essentially where can I put my capital and get an absolute 100% theoretically return on that money. And historically, it's always been the 10-year note, the 10-year treasury for the US. That model is obvious. If you've listened to our previous episodes, that might be changing with Bitcoin just being, a scarce asset, but we're going to stick to the 10-year treasury. Growth rates have, honestly, the yields have been on a tear lately, but I'm jumping to treasury.gov, and this is literally how I get my information. So I'm just jumping in. I'm going to grab the most recent. We're at 2.31. That is, okay. I was like, what? That is way higher than I expected. So the 10 years, 1.65. We just recently broke 1.5, which is honestly slightly concerning. But we'll deal with that in another episode. Plug in the long-term growth rate. This is essentially your measuring stick on, where can I deploy my capital safely and to get a reliable return? So we're going to find out if Ulta Beauty, how it stacks up against the return of, the long-term growth rate of the 10-year treasury. And that's just a really good sort of measurement of, hedged out fully risk to, maximizing growth. And that would be on an individual stock basis. So we've got our free cash flow history. I'm just literally going to pull it from our other spreadsheet over here. I'm going to take this, copy. Spreadsheets are fun. And then we're going to copy and paste. So we have some numbers here, and we might have seen it with a spoiler here, but I want to take a look really quick. This is why I did the growth rate. So what I have here is the free cash flow return performance expectations. This is understanding this is where we kind of get a little wishy-washy kind of qualitative feel out. Where do we think the company's heading? And what I like to do to feel that out is I'll first look at, the free cash flow trends. So we're looking at 29%. Oh my gosh. We're looking at 29%. And the way that I do things is I go pretty conservative. So like I'll usually take a few basis points off of these historical averages, but I'll look at 2011. This is the free cash flow growth rate year over year. So from 2011 to 2012, they grew at 16%, down 45, up 100. And then that spits out a 50%. And there's really no stability in the growth rates, but the free cash flow is reliably growing, which is a good sign, but it seems to be lightly plateauing. So I'm going to take a look, and 50 is the upper echelon. I'm just going to drop that down to 40 because there's no way that that's sustainable. I'm going to write 40 for the aspirational. Let's just call it likelihood 15%. And I have it over here because, we don't need to be good at math. We have calculators for a reason. Mm-hmm. The most likely, I'm going to stick it to 25. I mean, that's still pretty crazy to me, honestly, that they can do that. But it's been so reliable growth, even in the midst of a pandemic. And then pessimistically, let's just drop it to 10, which is sort of arbitrary. Okay. So what is Ulta trading at? I have this up here in our spreadsheet. So they're trading at 318 right now. I mean, and markets are closed. So we're recording as of March 14th, 2021 on a Sunday. Good morning, everyone. Happy daylight savings. So the stock is at 318, and I'm gonna go back to the stock calculator, and folks, take a look at this tool. Like, this is all you need to get is 10 years of free cash flow data, and you kind of work with your own estimates and, play with the numbers, be a little more conservative, maybe just copy and paste a few models that if there's a company that you really want to dig into, maybe have your pessimistic model, maybe have your model if, Ulta closes 100 of their stores, you can model that out too. So it's trading at 318, and the intrinsic value per share that we came up from our discount cash flow model, which is again, just projecting out the cash flows, discounting it back to today's terms to get a net present value, is at 329. So I won't say it's deeply undervalued from an intrinsic value per share price, but looking at these growth rates, and honestly, we can play with it to get even more pessimistic. They're expecting it. I mean, this is spitting out from an IRR basis. This is a 19% year over year buying Ulta Beauty.
And
That's awesome.
If you look at the S&P 500 historically, it's what, in the range of 7 to 9%.
7 to 9.
So like that's phenomenal. Yeah, that's awesome. That is an awesome return.
So I just really quick while we're playing, because we're going to just jump back to number. We're pretty much going to wrap up pretty soon, and we're going to get to a question from our audience. But I just want to play with some pessimistic numbers and just take a look at that. Like, get comfortable with your own expectations. Let's just say that, this is 35%. It's getting more likely. We'll say 15, and we're going to drop it down to 30. Okay.
And just letting you know, Ben's playing with the numbers.
I'm just messing around.
Yeah, so pessimistic, we think it's only going to grow 5% likelihood. Likely is 15%, aspirational 30, and then the likelihood that he's messing with. So he's saying 35% chance of this happening, 50% chance of this happening, and then 15% chance of this happening.
Exactly. And you're still getting a 12% return. So I'm gonna go
still
to my
beating the market, which is phenomenal.
It's phenomenal. So I'm gonna go here. This is my little spreadsheet. I just want to show you folks what kind of this looks like from a graphical standpoint. What did I have as the LGR?
164.
Awesome. So this is the upper band growth rate. I was saying 40 before. I was saying 25, and then I thought 10. I thought 60. What did I will just arbitrate. It doesn't matter. 30. We'll just say 25. 25.
And then 15. No.
15, it added up. It's just slow at math. So again, so I got pretty close to whatever I wrote before, because we're still getting around the 21.55. And then we're going to go up here, take a look at that growth rate. That's spicy. That's a very good looking model there. So cool. I mean, that's pretty much what I want to take a look at is we got, I mean, this number we're not looking at that right now, but I honestly, I'm happy to do sort of a full write-up for Ulta. I'm gonna stop sharing my screen for now. I'm happy to do a full write-up for Ulta, and Chris and I can take a look at that, and for when this newsletter comes out for this episode, and like and subscribe to our newsletter. I'll make sure that we have the full write-up for this stock. I'll do pretty much the full analysis that we went through with all the data plugged in. You take a look, and then you can always model it yourself. But this was a blast. I hope you guys really enjoyed this.
Yeah. So full disclosure, it looks like a great company, something that I would definitely consider investing in. I'm kind of strapped for cash right now, personally. I'm in the process of buying a house, and that's kind of capital intensive. I spent a lot of my money in investing in Bitcoin, and that's doing pretty well. I know we broke 61K this weekend. It's now down right below 60K. But I have a lot of money tied up in that I don't want to move. But yeah, overall, great company. I think it's great valued. Maybe in a couple months time when things settle down with, closing on the house and all the costs of that coming down, I'll consider, picking that as one of my stocks in my stock picking portfolio. But right now I just don't have the capital to allocate to it, but looks like a great business all in all. Ben, what's your synopsis?
I feel pretty good with it. And I'm going to take a little deeper look at it just to understand it. Like I'm not really, it's going to take probably a few weeks before I get comfortable with. Usually when I make a position, I'll do the research and then I'll mull it over for a while.
Yeah.
Because my thesis is that if this is a good business today, it's going to be a good business in 10 years.
Yeah.
I'm in no rush to make the investment.
Exactly.
If I am dreading, usually what I know when I have a good investment, because I kind of feel sick to my stomach before I press buy. That was my feeling for Delta during the pandemic. And that's been one of my best trades in a while. I just felt sick. I couldn't sleep after, which is make sure if you're
it's unhealthy, but
if you're experiencing insomnia, you should maybe buy an ETF. So no, this is a good business. Dimple, thank you so much for recommending. But looking at how to value a business that we're not familiar with, Chris and I could probably blabber about Tesla, and that's even more complicated than I can even talk to. But it was cool to look at a company that I had no prior expectations for. This was really fun just to look at a company I'd never looked at. So thank you for the recommendation.
Yeah, Dimple, thank you so much. We'll definitely be sending you something your way. I know Ben and I are trying to build out merch right now. We're trying to make it cool, so that's what's taking a while. We're not the best artists, but we'll definitely be sending you a bag of stuff. So thank you for recommending this episode. We'll be sending something your way. Any more wrap ups, Ben, before I get to the
No, let's jump right into it.
All right, so I got a question from my buddy Chris Canizero, swimmer from Rowan University. So one of my buddies, he was asking me to talk about Kathy Wood and the ARK Invest ETFs. So her main one is ARK, ARKK, but she has a bunch under the same. It's ARK, and then normally the last letter is something that changes. So, but I'm just going to talk about ARK, which is her innovation ETF. So. First things first, not many people had a better 2020 than Kathy Wood. Maybe Jeff Bezos, Elon Musk, very few people, but she's awesome. Kathy Wood, if you've not listened to her talk, she's normally on CNBC or just a lot of the investing channels. I know Ben and I are nerds like that. She's also been on YouTube with a bunch of financial YouTubers. She was on the Investors Podcast. She interviewed with Trey on that episode. It's a great episode. Kathy's a brilliant mind, and I love and respect her. She's awesome in the investing space. I always love her insights, especially on Bitcoin and Tesla, because they're very similar to my own. She thinks Bitcoin's the new internet money, and that's going to be the new way of the future. And she really thinks Tesla is, going to be the front run and the winner for the electric vehicle space, which I agree in both of those. I guess with that being said, though, I just have some qualms with her ARK ETFs or her ETFs in general. I love listening to her insights, but just it carries a gigantic expense ratio. And I know Ben and I have talked about this on previous episodes of 0.75 expense ratio. So it's very hard for me to want to invest in something like that over just a broad market index fund. Like, for example, VTI, which is Vanguard's broad whole market index fund, carries an expense ratio of 0.03. Yeah, they're investing in just the entire market and they're not, more specifically niche. You can outperform that if you pick stocks that do very, very well in that time frame. But it's 25 times cheaper than the expense ratio of VTI. I know when her ETFs came out in 2014.
Or the other way, VTI is 25 times cheaper.
Yeah, that's what I meant. Sorry, VTI is 25 times cheaper than her ARK ETF.
Yeah.
I apologize for that. Misspoke.
No,
So it's just hard for me to go into a business that's expensive. I know her ETFs, ARK ETFs, started in 2014, so relatively they're very new. We only have really 7 years of data, and while she was annualizing 14% returns, which is better than beating the market, I haven't run the numbers. The S&P 500 over that 7-year span was returning 11.5%, so a little bit higher than its annualized over its entirety of the S&P 500 over the 90 years or so that we have of that data. So it's a little bit higher, but those expense ratios compound over time. Like I said, I didn't run the numbers, and we'll definitely keep that in our newsletter in the show notes, where the NASDAQ overall for that time period was returning 46%. And then obviously this year she returned 150%, which is awesome, but it's kind of a hard comparison because with the stock market tanking so much and then recovering broadly, Kathy was kind of very big in conviction. And right when the market dipped, she put a lot more capital into those things and then saw explosive growth, with Tesla being one of their biggest position sizes. Obviously, with that exploding this year in terms of growth of what it went to in early March 2020 to what it is now, obviously she was going to do better than the market because of how its returns. Overall, I agree with Kathy Wood. She has a lot of warnings about value traps and companies that are high dividend paying companies. She sees them as losing long term because a lot of times when companies are paying high dividends, I know investors or dividend investors love that because it's passive income that they're receiving. But if you're paying out dividends but you're not innovating in your business, like if you don't have a website, that'd be a crazy example, but like if you have a very bad website, or if your technology's from the 80s, compared to the technology, what?
No e-commerce. You can't buy online.
If they have no e-commerce, if they have a very bad social media presence, not saying that if you good social media presence that your business will grow, but the way the world is changing, millennials, like our generation, and Gen Z, a lot of us are tied into social media. So if you don't have a very good social media presence, we might not find about it. And if we don't find out about it, we'll never use your product. And that's just a more broad generalization statement, but it's just kind of true. The way the world is, it's changing. You need to adopt with the changes, or you'll die as a business. I know that sounds a little harsh, but that's just the reality. So she's really pushing big dividend paying companies to, maybe she's not suggesting as what they should do, but it might be a better idea to cut back on your dividend. People will be pissed and your stock price will go down. But if you're taking that money that you'd otherwise be giving to the shareholders and reinvesting in the business, and you're able to grow the top line and bottom line growth of the company, that might be awesome. Like I said, so while I love Kathy Wood, I love listening to her advice. It kind of mirrors a lot of my own. I try and challenge that because it's sometimes good to listen to people that challenge your advice to get, not getting a bias. But love Kathy Wood, love her as an investor, and I think she gives really valuable insights. Just personally for me, it's not something that I'd want to invest in because of the gigantic expense ratio. I'll keep listening to her insights. I'll keep looking at ARC's portfolios as holdings and see what they're moving out of and what they're moving into. But that's just kind of my insight as me. Ben, anything you want to add to that? Sorry for the long-winded response there.
No, I thought that was perfectly winded. Very good wind. I agree with you, Chris. The 0.75, I don't think is like astronomical. Like it's really high. When you look at some like analogs, like if you're looking at, Chris and I were just looking at this before, is the NASDAQ, the Invesco ETF or fund, QQQ, which basically just tracks the NASDAQ. So, which is all tech, which is essentially what Kathy Wood's portfolio mostly is. It's pretty tech weighted and obviously Tesla weighted. I mean, you would have been better off just buying Tesla at the bottom, just buying it at the dip,
Yeah.
and you would pay zero fees to own Tesla because she's heavily in Tesla.
So there's one little note I will say. I looked at her most recent on Friday, a lot of her sales and buys. So
Yeah.
she was selling out of, I guess, more traditional tech. So she sold a lot of shares of Apple, Facebook, and Amazon, or basically
The
areas
FANG.
that she just like kind of parked up cash and just kind of let them grow in good businesses. And then she reinvested in her convictions of Tesla, Roku, and a few other businesses that, are big in her funds. So that just shows her conviction that if she's selling Facebook, Amazon, and Apple, which are great, great, great businesses, they're there for their reason. She just thinks the upside of the Teslas, the Rokus, and other businesses that she's evaluating, or even, Palantir,
Palantir?
Palantir, there we go. So she was selling these great businesses and investing into these businesses because she thinks that they're going to get better returns and they're going to be better businesses in a long time horizon, which I thought was very, very interesting.
It is
Sorry to cut you off
interesting.
there.
I think like that strategy comes with a lot of risk,
Yes,
right? Like she's
exactly.
investing in these really, really heavily overvalued from a numerical and sort of traditional value lens.
Yes.
These businesses are like trading at 1,000 to many hundreds of PE,
Yeah.
which to me is just dangerous. Like in my personal opinion, what I would do, like Chris just said, is they have to report their holdings. So why not just take a look at their holdings, see what they're investing in to get a flavor for how they're investing, what the strategy looks like, what they're kind of seeing down the pipeline for the future of tech, biotech, genetics. She invests broadly. Their strategy is innovation, right? It's the ARC Innovation Fund. So they're looking at things that are meant to change the world. But
Yeah.
what I would recommend, and whatever, take whatever you can, but find the businesses that you understand, and like if there are picks that you have high conviction, and you're like, I love Tesla, well then there's probably no reason to invest in ARC to get 0.75 expense ratio taken out of your profit. You might as well just go invest in Tesla. Yep. Or better yet, go invest in Invesco QQQ, which follows the NASDAQ, which has tremendously asymmetrical returns compared to like the Dow or the S&P 500, and you pay 0.2%. Those expense ratios eat up your returns over time, and the fund has to just reliably outperform against its competitor, being another benchmark, be it the NASDAQ, the S&P 500, whatever you're using as your own benchmark. But that is something definitely not to just scoff at. The expense ratios matter, and those eat up your returns in the same way that they do in the upside for growth. Growth goes downward too.
Yeah, Ben actually made this great chart for our company, actually, when we were presenting about 401ks and teaching, our fellow employees about it. It shows an expense ratio at 0.5, 1, and 1.5, and it shows over a 40-year or 50-year time horizon of how much of your profits it eats away of just investing $10,000, I think was our cost basis.
I think so.
Over the course of 40 years, and what it would grow to on an annualized, I guess 8 to 10, or maybe we did 10% return, but with 10. The varying expense ratios. We'll share that on our social media channels. It's something that's really, really interesting to look at. So that's pretty much all I got from it. Like I said, I really value Kathy Wood's opinion. I always love listening to her talk, especially on various shows, whether it's YouTube or CNBC on TV. I still really value her advice, but it's just ARC ETF is not something I'm going to be investing into anytime soon.
Yeah, and you know, just a word of advice to the listeners. You know, you might be listening to this and you're like, oh well, I really understand Kathy Wood's investment strategy. I believe in it. That's totally fine. Like that's the point of investing and having these discussions is you don't have to agree with Chris or I. Like
Yeah.
build your own opinions and like understand what you understand. But that's why you always want to get, you know, a contrary opinion when you can. Like these things where, you know, Chris and I are saying, you know, maybe look elsewhere might just be another opportunity to do an extra layer of research for yourself. You know, the most important person to convince is yourself. And my word of caution is don't seek affirmation in your investments. Like they say that good lawyers will write the opposing sides case before they write their own. So try to deploy that for your own investments. Find every reason of why you won't buy this business. And if at the end of it, you're like, I still like it, maybe consider making a position because you've done the research. That's the goal. But yeah, this is a lot of fun, Chris. Thanks for working with me on this.
No problem. Thanks, Ben, for leading this episode. Chris, thanks for the question, and Dimple, thanks for the suggestion for the episode as well. I think we're all wrapped up. Unless you got anything else to say, Ben?
No, we're all wrapped up, folks. Thank you so much for watching our episode. Again, we have a newsletter that comes out every single Monday, so subscribe. We post it to our channel all the time. Subscribe to our newsletter, like and subscribe on our YouTube and all of our podcast channels. One episode every Wednesday, unless we have an emergency episode. But all that support goes a really long way. So thank you everyone for watching and listening.
Have a good one, everyone. Catch you later.
Thanks.